Hello everyone and welcome to May's ifta webinar. I hope everyone is keeping safe. So tonight's speaker on the webinar, he's a coach, a trader and also a trainer as well. He's actually in the German Society, VTAD, and he actually runs the Hamburg chapter over there. He's written a number of books, Risk and Money Management Simplified, the same again relating to swing trading, and also 55 Reasons to Become a Trader. Also this year he's actually going to be the ifta conference director as well, so that's very, very interesting, and you'll find out more about that in the coming months. So without further ado, I'm going to hand you over to Wieland Arts. He's going to talk about the expander strategy, which uses two of my personal actual favorite techniques, Bollinger Bands and candlesticks, to form a high probability setup. So without further ado, I'll hand over to you. Thanks, Wieland.
Thank you, Tom. Thank you very much. Dear ifta members, I'm really pleased to be here together with you for this hour. Well, it's an hour, so 45 minutes up to an hour. And yes, I really appreciate the opportunity to get together with you through one of my favorite strategies. It is the expander. The question is, why is it called the expander strategy? That's what I want to talk about the next hours and minutes an hour. And yes, of course, we want to see how we can use Bollinger Bands and candlestick signals all together. Before we go deep into this topic, before we go deep into all of it, let's first of all talk about some disclaimer and risk disclosure. Of course, I don't read it in total. I just want to point a few things out. First of all, this is, of course, some kind of impulse I want to give you. I want to give you the impulse to think about if, first of all, if trading is right for you. So if you like that style of trading, or if you try like trading in short term or long term or midterm. So this is the first thing I want you to think about. And second, I also want to think you about the strategy, if the strategy is also right for you. And if you feel like you want to use a strategy, I highly recommend just to think about what you can change in the strategy, so to make sure that this works just for you. Because trading is highly individual, and a strategy I like doesn't mean that you will like it the same way. So maybe you want to make some changes, and feel free to do so. Second, if you gonna trade, please make sure and be aware that trading is has a high risk, and that you can lose money, and maybe you want to lose money. So please make sure that you are highly aware of your risk, and that you always keep risk management in mind. And of course, I don't want you to trade, or I don't give any recommendation to buy or not to buy. So if you trade on your own responsibility and on your own risk. And if you say, yes, this is what I'm going to do, then we can continue. So I read a quote in the internet. It's a quote from Tom and David Gardner, and it goes like, when it comes to your money, only trust one person, yourself. And I think that this is the reason why all of us are trading on our own, why we gonna do all this analysis, and why we set ourselves always again at risk, and try to get the best out of the markets, and just to make sure that we can make our own decisions. And this is why we talk about technical analysis, why we talk about strategies and all the other stuff regarding to trading. So when it comes to your money, only trust one person, yourself. And as I read this, I feel like being on fire, because this is exactly what my mission is, just to give you and a lot of traders in the world, or in Germany, especially in Germany, some ideas how to trade. So this is me, Wieland Arts. So Tom introduced me, and thank you again for this. Here are my two books. They're both written in German. I also have this one in English. It's available on Amazon, so Risk and Money Management. If you want to read more about this, go to Amazon and check this, and it's also available as an ebook. And if you're a Prime member, I think it's for free, as it is for Prime members. They have it in the Kindle Unlimited program, I think. So far from me, and now let's go deep into topic, and let's talk about the strategy. And first of all, the question is, what is the idea behind the strategy, the expander strategy? So thinking of trading and thinking of all the strategies and ideas of how to go or how to enter a market as a trader, a lot of us are talking about the Dow theory. So what we can do, or what you can learn from the Dow theory, is that we, of course, have a lot of, well, descriptions of how a trend is described. First of all, there's a movement in the direction of the trend, which is the impulse movement. Then we have the correction of the trend, and then it is impulse movement again. So we have impulse, correction, which is, if you're in an uptrend, which is a higher high and a lower low, and if you're in a downtrend, which is a lower high and a lower low. So this observation applies to both, to rising and to falling markets. And at the same time, you don't have just not only an uptrend or a downtrend, we also have a sideways trend. I think this is not so new for you. So the question is, how can we trade all of these stages of a trend? And this is
Wieland, just
yes.
sorry, just quickly, just a few people. Would you be able to speak a little bit closer to the microphone? I can hear you okay on mine, but a few people are struggling to hear.
Sure.
Sorry.
Yeah, I can go with a little bit more gain.
Yeah.
All right.
Yeah, that's it.
Okay.
That's much better. Yeah. Great.
Yeah.
Thank you.
Okay. Excellent.
Sorry to interrupt.
Yeah. Don't worry. So the question is, how can we approach all these three stages of the market? So uptrend, downtrend, sideways trend. And the challenge for us as traders is just, first of all, to identify all these phases, and of course to find the proper strategy for it. And honestly speaking, our toolbox as traders is completely packed with strategies. But the one and single question I ask myself is there a strategy for sideways markets as well as for market corrections and trend continuation? So is it really possible to use one and the same strategy for all of the three market phases? And this is the idea behind the expander strategy. So the expander strategy has two ingredients. First of all, it's the Bollinger Bands. And honestly speaking, I love the Bollinger Bands. And I'm really, really thankful for these bands to John Bollinger himself. So I never met him. Maybe I will do so. Then I can say thank you in person. So when it comes to Bollinger Bands, let's hear John first. He says, Bollinger Bands are channel lines drawn in and around the price structure in the chart. Their purpose is to establish the relative definitions of highs and lows. Prices near the upper band are high and prices near the lower band are low. Well, just think about what this says. Well, usually a lot of traders, they just read this and then they go on. But I want you to think about what John really says with this quote. He says that prices are not just high or low. He says that if the price is rising, and if the price is rising to a certain area, then it's not just high, it's relatively high. And the question is, if the price is relatively high or relatively low, compared to what? And this is the moment where things are getting interesting, because if prices are relatively high or relatively low, we ask ourselves, compared to what? Then the answer is compared to its average. And this is a moment where we can think about some kind of a strategy, because if the price is relatively high or relatively low compared to its average, then the next conclusion might be that maybe the price will also return to its average. First or second, that the average will go to the price. So both happens, but the indication of the Bollinger Bands implicate more the first one. And this is where I thought, well, this could be interesting. So let's go deeper into it. John Bollinger developed his bands in 1983, so more or less 40 years. And through all these years and all the time, Bollinger Bands are nearly unchanged in their usual settings. So in the basic settings are pretty unchanged. You can use the bands I don't know if you're familiar with them, but you can use them in all markets in all time frames. You can use them everywhere, and this is why they are so great. But well, at the end, this is what technical analysis is for. You can use technical analysis in every market and also in every time frame, but especially the Bollinger Bands. The original version is based in daily charts, which were back in the days, they only had daily charts and not just as today we had intraday charts, a minute chart, a tick chart. Back in the days, 83, they had daily charts. And John took just a simple 20-day moving average as basis for his calculation and 2 standard deviations, which is just a measurement for some kind of statistics. So if you want to know more, learn statistics. So John did a great job with this because the Bollinger Bands can be used for all trading styles. So if you're a day trader, you can use Bollinger Bands. If you are swing trading, you can also use the bands and you get great results from that. You can get. So it's not a promise, it's just my idea to use them. And you can identify with the Bollinger Bands great trading opportunities with a very good risk and reward profile. And this is true quite often. So you can find very good opportunities, very good setups, very good entries, and also exits for a trade. And I will show you how to find them. Standard setting, again, is just a simple moving average, period 20, which is very simple. I love things which are simple because, don't make trading too complicated. Usually, it's fair enough just to use the price and use maybe a moving average or one indicator if you like to, but don't make it too complicated. Bollinger Bands are perfect for keeping things easy, using moving average 20, simple 1 and 2 standard deviations up and down, and then you have the bands. And again, this setting hasn't changed since 83. Of course, you can do so, but well, there's no reason to do so because they still work today. And John also made a long-term test, and he discovered that about 89% of all prices are enclosed by the bands. So, and there's also a quote: with 20 time units and a standard deviation of 2, in most markets between 88 and 89% of prices are enclosed by the bands. So let's round it up. About 90% of the prices are enclosed by the bands, so they are within the Bollinger Band. And I just leave this also here for discussion. What does this mean? First of all, let's combine both insights. First of all, prices in the area of the Bollinger Bands are relatively high or relatively low. That's one. And then you see that around 90% of all prices are within the bands. So there are 2 conclusions of this. First of all the prices inside of the bands aren't relatively high, relatively low. So from our point of view and for our trading ideas, we don't have to care about them. And I think this is pretty cool just because this filters a lot of movements and a lot of signals you don't want to trade. Second, what happens to all the prices which are outside of the bands, like the prices, like the 10% of all prices? First of all, obviously, they are in the minority. The majority lies within the band, and the minority, the 10%, are outside of the bands, right? So this means that you have a high probability for a reaction. And the question is, if you have a high probability for a reaction just because prices aren't even relatively high, but they're even more relatively higher compared to what? To its average, then you have a quite good idea that these prices might return to their average. And this is why I thought, well, this could be a quite good strategy to use. And here we have some Bollinger Bands. This is great Britain pound to the US dollar. We have a daily chart here. And what we see, I don't want to count, but I think it's pretty clear that more or less 90% of all prices are within the band. So we don't want to discuss this. And you also see that if the price goes outside of the band, right here, then the chances are really likely that the price will correct. That will go up, it will go down. And you also see this is not a promise, but it's likely to happen. I also like this. Price goes outside of the bands, coming back. Outside of the bands, coming back into the bands. Outside, and it don't take any longer. Prices go inside. Outside, go inside. And it's all over the same. I really like this one. You see what happens. Price go up, go down, come back in. And this is trading. You want to trade some distance of the market movement, and then you want to exit. And with the Bollinger Bands, you get quite a good clue of where to enter and where to exit, just because you follow the market's move. Is it always the perfect exit? Obviously not, just because you exit maybe here, and then after that the market goes up, then you exit here, the market goes even further. But this happens. But you have to make a decision, and the decision is at what point is the probability that the market will move in a certain direction the highest? And we can answer this question with the Bollinger Bands. And that's why I really love the Bollinger Bands. But of course, this is not the only ingredient of the strategy. We need some more. So second ingredient of the strategy are the reversal signals with hammer and shooting star. Why do we need some candlesticks here? Well, let's hear Steve Neeson. He says, no other chart method can compete with candles when it comes to diagnosing the health of the market. Yes, of course. And that's why I also really love candlesticks. And Steve is really, really true with this. Because if you want to know what's going on in the market, if you want to know what market participants really think or how they feel, how the emotions are, then you're good with candlesticks. So let's see what candlesticks are about. Of course, when you interpret the candlesticks, it's very important just to understand what the upper and lower shadows mean and what the candle body says in relation to the shadows. So I call them shadows just because to make things easy. But of course, there are some official words for them, like in German it's Docht, but we want to call them shadow. So we want to make clear that we know what's behind the shadow. We want to know what's behind the candle body and what the comparison of all of those of both really means for us to make a decision for a trade. So the observation of the shadows in the connection and comparison with the body gives us a deep insight into what happened in the market during the period under consideration. So if you go or if you watch a market and if you see some kind of setup developing, then you see that the price is moving within a candle, and the moment the period is over and the candle is filled, you see really with clear view how all the market participants feel like. And I will show you soon why I really say that you can measure all the emotions of the market participants, of all the traders in that or regarding to that certain period you are watching. So in addition, again, you get the emotions of what's going on in the market regarding to the traders, how they feel and how they will react or act within the next period. So we get a good information with the candlesticks about how much willingness to buy or to sell is available in the market. So you know if somebody will leave the market, if somebody will sell, if somebody will buy, if the majority of the market participants is about to sell or to buy. And this is what you can read from the candlesticks. So we can get a lot of conclusions about the next move in the market. For example, if you see a long candle body with little or no shadow, this is the absolute picture of power. So this suggests that one side really dominates the market, and that this side, like buyers or sellers, that they are really, really powerful, and there is no chance for the other side for, like, let's say you have a green candle or red candle. Let's say you have a red candle, like first one, that one you see right here. So if you see a candle like this, there is no room for buying. This here might be profit taking, but it's not really buying. So this is what we can call the picture of power. And the same is true for the green one here. So market opens here, down, maybe a point or a pip or so as a low, and then went straight up, making a high. And this is also just profit taking. But there's no room for selling. There are no sellers. And yeah, if you see a candle like this in sitting at the right spot in the chart, this is obviously also very important. But if you see a candlestick within a move, what do you think? Will prices go up? Will prices continue to go down? Chances are very high, right? So it's very likely that the next period, the price will go into the direction you see this big fat body candle just marked and showed. How long will it go? We will never know, of course not. But what we can conclude from this is that the chances are very high that the price here will fall and the price here is likely to rise. So this is what we can read out of the picture of power, because there's just one side who has really the power in the market for that period of time, for that moment. So the bigger the body is, the stronger is, of course, the one side, the winning side. And the smaller the body is, the greater is the uncertainty in the market regarding the further direction of the trend. That is, if you see just a small body and long upper and lower shadow, you see that nobody really want to engage himself. It's like you're passing the hot potato to the other person because you don't want to hold it too long. And this is what happens in a candlestick, in a period that builds such a candlestick with long shadows and small bodies. Nobody really wants to have a stock or an asset for a long period of time. So it's just buying, selling, passing it over. And this is some kind of uncertainty, because market participants aren't certain about the next period or about tomorrow. They don't want to hold it. They just pass it away. They just give it away. And you can read this from the candles. And this gives you the next idea of where the market will go in the next period. And also here, it's very important to see where you see such a candle. Is it at the beginning of a move, or might it be the end of a move? And let's say you see just 2 or 3 of this long fat body candles, and after that you see just a candle with a small body, long upper shadow, long down shadow, lower shadow, and then the idea comes into play that this might be some breaks. People break, market participants step on the brake and slow down, and this is uncertainty. So it's like a tug of war where buyers and sellers becomes that they don't know if prices will rise, continue to rise, or will they begin to fall, or do they continue to fall, or will they begin to rise? So nobody wants to stay longer in the direction as needed. So this is what we can also see in the market, and you kind of see what happens here. So just imagine you see a candle like this, where we have an open right here, and someone hits a high. But can you imagine what has happened between the open and the high? I'll show you. This is what happens. So first of all, you have the open, and maybe you are a buyer, so you feel really good about it because you just bought at the right spot, you earn profit, but suddenly price, I don't know why, but price falls. And all of the buyers, all of the traders who were in profit, who were winners, they are now losers. Why are they doing this? Because also here is somebody who just bought. Some poor guy just made the last price. And this poor guy is not a winner. He's not a profit. He's a loss. He is a loser with this trade. The same is true for this. So market opened, the price dropped, building a low, some sellers stepping in, pushing the price down, but somehow at some certain point, we find some buyers and they buy the market higher and they buy and they buy and they buy, pushing, pressing all the sellers out of the market, and all the sellers who have sold here, they are in a loss. And now the question is, first of all, how do they feel? Just imagine you would be in a position like this. How would you feel? Well, honestly speaking, I wouldn't feel so comfortable because I'm caught completely on the wrong foot. I might be a buyer and now I'm in loss. So what will happen? If you ask me, the moment price drops below this low, I would exit my trade, right? Why? Because I don't want to go deeper into the loss. And this is what happens to a lot of market participants. So the question is, if you see a candle like this, at the right position, then this might be an indicator that prices will drop. And the same goes here. So if you have been a seller, then chances are pretty high, if the prices break this high, that the price will rise and continue to rise. And then you're better off when you close your short position, right? And if you close your short position, you're not a seller anymore, but you become a buyer, just giving this a little bit more push. So if you see a candle like this is pretty clear that something is wrong here. But what happens if you see a candle like this? I will say that something is very wrong here, just because this candle here has been completely red. And now, from all of this selling, and also here, there's a poor guy making the last price. This is a poor guy who made history, because you see this price in the chart forever, right? But at the end of the period, what is left of all the selling is just a shadow of himself. And this is very powerful. So what happens here, if you are caught on the wrong foot, if you are the poor guy who sold here and you find yourself at the end of the period here with quite a big loss, I'm pretty sure that you don't watch how the market destroys your account or your position. Maybe you want to exit here because you have to take your loss. And then price rises. This is the idea. And the same is true here. So if you were a buyer and this was completely green, and now you find yourself completely caught in the wrong area, in the wrong direction, then you may close your position just to make sure that you don't get any deeper into your loss. And this is what we are waiting for. This is what we want to see when we want to enter a trade and when we want to open a trade. And of course, you know how these candles are named. So, but before we want to talk about these. So this is what we know as a doji, right? So we have talked about this tug of war. We talked about small candles or small body candles with long upper and lower shadows. And of course, this is some kind of indecision, because you don't know, as a buyer or a seller, will the prices rise? Will they continue to rise? Will they fall? Will they continue to drop? Nobody knows. So the question is, what's next? And also here, depending on where you find a candle like this can be a reversal signal. This can also be not really a continuation signal, but of course it says, hey, we need a breather and we need a break. We just want to make a little pause. And this is what this candle says. So the question is, what's next? Everything can happen. According to Steve Nyson, it's of course, he says, well, chances are likely that price will reverse. So if I got him right, he says, if I see a candle like this, I just jump into the opposite direction. Okay, you can do this. I wouldn't do this, but well, you're free to do. So this is what we know as a doji, and this is also a sign of indecision. So coming back to these nice candles where you see just a small body and a long upper or lower shadow, these are called hammer and shooting star. I think most of you already know these because they are very common and very popular, and they work really good because they have a hit rate of around 60% according to Thomas Bukowski. And he just made great books about all the probabilities and hit rates, and he also tested hammer and shooting star and came around 60% hit rate, which is already great because if you have 6%, so 6 trades out of 10 are winners, there is no problem for you to live from trading, right? So we want to wait and watch for hammer and shooting star. So what do you have to wait for? First of all, you need to have a down move, if it's a trend or just a move, but you need at least some candles going to the downside, and then you want to see a hammer developing. So I like to entry with a stop buy, like here, and I like to leave a little space between the high and my entry point, and I also like to leave a little space below the low and my stop loss. Why? Well, I think you all know the little tricks and games the market plays. You see an uptake or downtake, you see like a cent or a pip above the high, and then you see that market goes here and then likes to turn, and I don't want to be fooled. I want to make sure, all the same is true for this, I want to make sure that the market is really serious. I want the market to prove to me that he is serious about his next move. So I leave a little space and also take care of the spread, of course. So make it spread plus one, a pip or a cent or a point or whatever. So leave it like this and then make sure that market is serious. So make it a stop buy and let yourself put by the market into your trade. Why do we need a stop right here? Well, if you have a probability of 60%, a hit rate of 60%, and the market fools you in like this, and then is strong enough in its move to take this out, then you don't want to be into a market that is so strong, killing a hammer, that you don't want to have a long position. You want to close your position, you want to take the loss, and then you will see how the market develops after that. And the same goes with the shooting star. So you have an up move, like an uptrend or so, and then you have your stop sell with a little space underneath the low and your entry point, and you will also have a little space above the high and your stop loss, just to make sure that you don't get fooled in or fooled out by the market. And then the idea is by 60% that the market will drop a little bit. How far? We will never know. But maybe the Bollinger Bands will help us with the question. So this is the idea. This is what we want to watch for and what we want to wait for if we want to use these candlesticks for a reversal. And here we have hammer and shooting star. And again, we can mark them here. So we have a down move, and this is very steep, as you can see here. So it goes, that's why. Anyway, I take the laser pointer, here you go. So it goes very steep down, and as you see, we have some interest of buying. Market goes up, but this is not a hammer. Why ever marked it? Because a lot of people like to say, okay, hey, this is buying power, I enter the market long. And of course, yes, the market went higher, but it wasn't strong enough. The buyers weren't strong enough. So what happened? Market dropped a little bit. And this is a hammer. So how can you distinguish a hammer from this? Prerequisite for a hammer is, you see this body, this red body, the shadow, the lower shadow of the hammer has to be at least have the double size of the body of the candlestick. So the body, one, and the double size of the shadow. The shadow at minimum has a double size of the body. Then you have a hammer. So longer the better. I also have an example for this, but later I will show you. So this is the hammer. What you can do, you enter market. You enter the market with a stop buy, and then you go. And as you see, you get the perfect entry for this move. And all the traders who are, let's say, trend following, just waiting for a pullback, correction, entering the market, they are very late. Maybe they want to enter here. Maybe they are pretty brave and enter here. But you, using a hammer, you are just right from the beginning in this trade. And this is really a great entry. And you see, this is a V-shaped reversal. And using a hammer, you can get a perfect entry for that. But I know there are also a lot of traders who say, okay, I like to go with the trend like this, and I like to enter the market at the end of the correction. The question is, when is the correction at the end? This is the moment where the correction is at the end, when you see the shooting star. See some selling power, but it's not powerful enough. This is the shooting star. And again, you have twice the size in the shadow of the body. And off you go. And again, if you're a trend follower, then you might enter here with a classic approach of 1, 2, 3, but you're very late. If you use the shooting star or the hammer, you are more or less the first to enter the market with this new move. And as a trend follower, this is also perfect. And you can add to your position with the next strategy, but by using the shooting star, you have a perfect entry. And of course, you can not just only use hammer and shooting star, you can use also some other reversal formations like dark cloud cover, piercing pattern, engulfing pattern. I really love engulfing pattern. They are so powerful. They're even more. They have an even higher hit rate than 60%. I think they're about 70% or so, up to 80. And you can use the evening star, morning star, which are 3-candle formations, dragonfly, greystone, doji, which has the same ideas of hammer and shooting star, and but they're still doji because they don't have a body. And all of these have a high probability of occurrence for profitable positioning, and you can use them also for the expander strategy. So we just talked about the Bollinger Bands, and we just talked about the reversal signals from the candlesticks. So now we can combine both, and we can go into detail. So, and again, I like to quote John Bollinger himself, and he says, the touch of a band by itself is never a signal, and he is absolutely right. So we have seen a chart with the Bollinger Bands, and we have seen that the price goes outside of the bands, and of course, price doesn't reverse immediately. But the moment the price goes outside of the bands is for us a good indicator just to sit straight, watch the market, and prepare ourselves for the trade. Because we want to see that the market takes on a reaction, that the market participants, they already are doing what we are waiting for. And this is what we want to use the candlesticks for. So in combination with the candlestick signals, the Bollinger Bands give us very interesting insights. First of all, we have classic reversal candles, hammer and shooting star, in the area of the bands. They are a very good signal, and they give us an indication if the trend or if the move, let's say it's a move, if the move reverses or not. But if you see a shooting star, of course you see that the up move has come to an end. And this is true also for the other formations like engulfing pattern and so, which I mentioned before. And this is even stronger if you see these candles outside of the bands. So if you see that, for example, a hammer, if the price shoots out of the bands and you see a hammer which is completely lost in the universe outside of the bands, then it's not just only, well, relatively low, or it's a 10%, it's, let's say, 3%. So the chances that the price will reverse are very high. And this is what we can bring together with the knowledge of candlesticks and also with the knowledge of the Bollinger Band. So this is really the combination of a high reaction probability of the prices outside of the bands, 10% or less, and the price reactions that have already occurred. So we see that traders have already done what we are waiting for. We were waiting for a reversal because we know, okay, if the price is outside of the bands, chances are high that price will reverse. And now you see with the candles that they are already doing it. So we have double high probabilities, right? And this gives us a really powerful strategy for us to get very profitable signals for both, for trend followers. So if you go with a trend, trade out or trade from the correction. And of course, if you trade counter trend. So I'm more a counter trend trader. I don't know why. I feel more comfortable with that. And of course, you can also use this strategy for the trading range. But of course, you need to know where you exit just to make sure that you get a profit. And this is what I call a trading range, right? So this is Aussie dollar to the US dollar. We have a 1 minute chart, so it's very short term. And this is what happens. You have a down move, you have an up move, price goes outside of the bands. You see a very nice shooting star. You see this? This is also a shooting star, but it's inside of the bands, number one. And I really like stop entry. Why? Nothing happens. But if you say, oh, I see a shooting star, I just go short, you will be stopped out. But if you say, oh, this is a shooting star, let's see if the market is really serious, and market has to prove to me that he's serious about it. So I give it the space, stop sell, stop loss, and here you go. See what happens. And this is perfect for us. The price stops at the end, so the down move stops at the end of the Bollinger Band, so at the other side. You want to exit your trade here, and then you made the whole stretch from the one side to the other side, and then you continue. So here we have dojis. Obviously, you have a strong up move, and then suddenly some kind of exhaustion, step in the break, a little fake. This is nice, right? A little fake, and then price correction to the other side, moving higher, and then you see shooting star again, and you see also this. This is also a perfect example for traders who like to place or shift their stop loss, or let's say to break even after they have caught some profits. What? The color doesn't make any difference. So what's very important is the shadow, upper shadow or lower shadow, at least twice the size of the body, but the color isn't that important. So you see this, the market goes, the price builds a shooting star. And you have also here a little engulfing, bearish engulfing, which doubles, which is also quite a good hit. So what happens? You enter here, you're a little bit in profit, you shift your stop loss to break even, then you got stopped out. Yeah. And this is very, very often. So this happens very often. So my suggestion is a different one. I go into detail later on, but just be aware that you don't get stopped out without you. You don't want to get stopped out during a move, and this is just a correction of the move. You want to get stopped out if you are wrong with your idea, then you want to get stopped out, which is here, of course. So this is one example, and this is what I call a hammer, right? So, and obviously it doesn't matter if this one is red or green. You see this long lower shadow. So you want to enter here. This is a down move. This is 0.5%. I don't know. So it's so seldom. So you want to enter here. You see, you're immediately, this is a daily chart. You're immediately at the middle of the Bollinger Bands. Why not a little bit profit taking? The market goes a bit higher, makes a correction, then stops at the end at the other side of the Bollinger Bands, and what you see is that you also have here, you have this, well, this might be a bearish engulfing, it's not so clear with Forex, and then market goes again to the other side, and then you can exit. So this is perfect for situations which are not so clear, like sideways markets. You can play this all over again. So you can add to these probabilities with supports and resistances. Just imagine the expander idea appears at a resistance. So you see market shoots out, price shoots out of the upper Bollinger Band, making a shooting star at a resistance. This is a premium setup, right? Trend lines and channels, reversal formations, Fibonacci retracements, some indicators, oscillators. If you want to use them as a filter, feel free to do. So we're running out of time, so I'm just speeding a little up. We have the parameters of the strategy, just to give you more details how I like to trade this. So prerequisite for a long trade, market has to be in a downtrend, obviously, otherwise it can't reverse, right? So a new low is marked outside of the band, and this is also a key element. So you need to have a low outside of the band, price has to go outside, and it's like in that expander, you can stretch it forever. So the moment you have overstretched it and you release it, it will snap back. And that's the idea, right? So the price rises from the low and forms a hammer morning star PC pattern or a reversal, a sign of reversal. You want to entry by stop buy above the high of the signal and candles. Stop loss is below the last low. Just remember a little bit space between both, just to make sure the market's serious. You don't want to get fooled in or out. My first target is the middle Bollinger Band, so the simple moving average. Why? First, as I designed the strategy, I told you I'm a counter trend trader. I like counter trend trades. I thought, and I said, okay, I like to trade the mean reversion, so the reversal to the simple moving average 20, just to the average, and that's it. And then exit in the trade, and I'm done. And then I realized that the markets pretty often go further to the other side. So that's why I like to close part of my position, like 50% or 2/3 of the position at the middle of the Bollinger Band, and leave the remainder until it touches the other side of the band or comes near to it. This is one idea. Second idea is, we can go here with this situation. I have the Nikkei here with the bands in the daily chart, and I also like to present the next idea to you, which is very important. So just imagine you entered the market, let's say here, you have a bullish engulfing here. So you have to stop by, and this is what usually happens. You enter the market, and then you are completely uncertain about what is happening next. And this is where a lot of traders make a lot of mistakes. So you have made your decision. Your decision was, I enter long, period. This is where you have your stop loss. There's nothing to do. But I know it's a very uncomfortable situation, right? So you see that you are really caught on the wrong foot. So this is how it feels like. But obviously, there's no need for action. Your stop loss is here. Nothing happens. Everything is good. So this is one point. So you will be very happy to exit half of your trade right here, getting a small profit, and just wait until something more happens or until the trend unfolds. And this is where you exit with the remainder of your position. So this is a very, very uncomfortable situation, but just to make sure you have a strategy, you need to have a belief in the strategy, and you have trust into your strategy. So you have to trust yourself. So you made your decision, you enter here, this is stop loss, this is where you exit with part of your positions, where you exit with the remainder of your position, and then you're done. So this is still a winner, but it's not a very comfortable winner. This is more comfortable, right? But again, this is the dollar to the Swiss franc. This is a weekly chart, so it's a lot of power. So you see, you can use it all time frames. You can use it as a minute and also weekly, monthly. Here we have bearish engulfing, doji, and story goes down. Enter here, stop loss here, and this is where you want to exit half or 2/3 of your position. So what happens usually again? So you're in a profit, okay, I go break even, and then you're out. So don't put it break even. What I like to do is, as a management idea, exit half or 2/3 of your position, leave stop loss unchanged. So no matter what happens, you are more or less break even if you got stopped out with the half of your position. So you made a small profit, which is more or less likely one-to-one, and then you're more or less break even or having a small loss if you go out of your position with 50%. If you go out of your position with 2/3, then everything is fine. But you have to make sure that you get all of the chances and that you catch the whole move, and this is where you exit the remainder of the position. Then you see market correct, so everything done right, and then you can go over to the next strategy. Maybe you want to go as trend follower here or trade this. So there are a lot of possibilities, but this is obviously during all the months, this is with this hammer, you get the lowest and the best entry in this move, right? So, and this is how you can go with this. And you can also get, of course, go short. Prerequisite for a short trade is, of course, you need to have an uptrend and you need to have a high, a new high, which is marked outside of the band. And if the price falls from the high and forms a shooting star, evening star, dark cloud cover, or bearish engulfing, you want to entry with a stop sell below the low of the signaling candle or candles, and the stop loss is placed above the last high. Target number one, middle of the Bollinger Bands. I personally like to leave stop loss unchanged. Maybe I got stopped out break even then in total, but I leave everything open to the market. And target number two is the opposite Bollinger Band, and you have this here. This is Nikkei again, the daily chart. This is, what is this? This is a shooting star, and in total it's also evening star. So if you do it right, enter here, stop loss here. And this is the situation I'm talking about. So you have your stop loss here, you exit 50% or 2/3, it depends on the position size of your position, and leave stop loss unchanged. Why? See this? So it's not, just imagine, more or less it's on point. So, and just imagine you got stopped out break even just because you didn't want to lose, or you didn't want to give a profit. So, and this is exactly what it did. So this happens all over, and you don't want to miss this move. So this is why you got out by definition. And this is a perfect example for this, right? So this is how you can trade the expander strategy, and this is what you want to look for. So of course we have some alternative scenarios and how to manage it. I go very fast through it, and then I'm open for questions. So what happens is, if you're familiar with technical analysis, then of course you know if you go into the market like I just showed you, there are quite some things that can happen. What can happen is that you will see something like this, a flag. So you enter here, for example, with your hammer, and then you see how the flag builds. Honestly speaking, you don't want to wait until you got stopped out. If you see something like this, try to find an exit, just because, you know, this is a trend continuation formation and it's nothing what really brings you a big profit. Try to get out, more or less break even, but try to get out. So this is how it unfolds. This is some kind of alternative scenario. The same is true also for the pennant. You can see something like a double bottom or a double top. That is, you enter the market, let's say here, double bottom, you enter here, and then the price goes up, everything looks good, and the price comes down. So what to do? Exit, taking the opposite trade, opposite direction, just to see this. This is what also can happen. We have seen in our examples that This is very powerful, very strong. But of course, sometimes this happens, and this brings us a little bit it makes us feel uncomfortable. But we have to go through this. This is what we have to do. We have to wait. What happens? This is what our stop loss is for. I know. I also hate this, but this happens, and we have to trust ourselves and our strategy. And the same, 180-degree reversal is pretty clear. You have this is your entry, and then you have this nice candle. This is 100 going down. So stop loss, you're done. That's it. So, and this is also why I like the strategy. You get a very, very close result. So you don't wait for a result like following a trend, breakout or so. If you're wrong, you really know it very fast. Snapbacks, choppy markets. So if the market's not very sure and it's choppy, this happens. But again, with the strategy, you have a very comfortable entry point, and you know very, very fast if you're wrong or right. So all this emotional trouble won't last too long. So this brings us to our conclusion. So obviously we have a very good visual support for our turning points, potential turning points, and we get an excellent, if everything works out right, we get an excellent risk reward ratio with this strategy. And we can go for it within the daily time frame or short time frame, long time frame. We have seen minute and weekly charts, so everything can be done. So what you need to keep in mind, of course, is that it is a counter trend strategy. This is very important. So your profit possibilities can be limited. That's why it's quite a good idea to exit parts of your position at the middle of the Bollinger Bands, just to make sure you don't get the full loss, or you might get a small profit. So this is very important, and also always take care of your risk management. And saying this, looking to the clock, I see I just took an hour or so. So I'm open for some questions, like is slide available? Yes, you can send me an email. It's wieland.alt@ifta.com, and then I send you the slides as well if you like to. So if you search me on the web, you will find me. So if there are any questions, I'm more than happy to answer them.
Perfect. Thanks, Wieland. Very good webinar. I really enjoyed that. So yeah, just had a few questions come through. So I guess sort of first off, and what I'm also quite interested in myself is, have you actually gone through and back tested this? Because it's quite sort of a well-defined set of rules. So I don't know if you've looked at that to see how successful it is.
Honestly speaking, I'm more the guy who makes a visual backtest, like going through the charts. I haven't done a backtest with a computer, just because of all the possibilities. So, but I would be more than happy if somebody would help me out with that. So give it a try.
I might take you up on that. Just got quite a good question actually from Patricia, just about how, I'm guessing you have to have both the signal, so the close outside of the Bollinger Band. It's a close, isn't it, as opposed to just, it has to actually close there. So you would actually need both to confirm the position. You wouldn't take a position if you've got conflicting signals with you from the Bollinger and the candlestick.
If we, if first of all, usually I don't get really conflicting signals, because this candlestick is this candlestick, and the position is pretty clear inside or outside. There might be some signals where you say, well, as a rule of thumb, I feel like this is a hammer.
I guess if you could have like like a shooting star or a hammer, but you don't actually have the close outside the Bollinger Band.
Yeah.
So you wouldn't take the signal then, I guess, in that case, would you?
As a rule of thumb, the clearer it is. So the examples I showed you, there were no discussion about what is going on. So they were very clear, and just because of that, they work. The moment you think too long about, is this right or not, I can tell you it's not right. So leave it.
Okay, and then just a question here actually, does the colour of the hammer, whether it's a shooting star or or a hammer, doesn't make any difference? I don't think it does it? But
Now, by definition, it doesn't.
yeah.
So what's more powerful is the upper or lower shadow. This is what is really really important. But I mean, if you're caught on the wrong foot, you're caught on the wrong foot as a trader, and this is what this shadow indicates. And you don't care if this small body is green or wrong because you're deep in the loss. That's the emotion, right?
Yeah. Have you looked at so Keltner bands are sort of quite similar, obviously based on volatility as well. Have you looked at those as well, or you've just focused on the old Bollinger Bands?
Now I focus on the Bollinger Bands
Okay.
because I started to use the simple moving average 20 before, and I thought, hey, this is a good addition, and that's why I love them. So yeah, I know the Keltner bands, but I like more the Bollinger Bands. But this is exactly what I want you to do. Take this as an information and go further. Use it for your own thinking and try it. So if you're more familiar and if you feel more comfortable with the Keltner bands, go for it.
Are you just trading this on dailies, or have you tried it on sort of other time frames? And
No,
which?
I'm more an intraday trader. So
Okay.
I do it really short term, like
60 minutes or
5 minutes, so
oh,
very
really well.
short
Okay,
term.
very short.
And as a rule of thumb, also here, the higher the time frame, like 60 minutes a day, week, the better the signal. Because
Yeah,
nobody is
yeah.
looking for a minute chart in an institutional way, but everybody's caring about weekly chart, right?
And then, yeah, do you find, because obviously you can have quite long wicks on the old candles, especially for, yeah. So how do you, how do you sort of, do you look at the sort of the risk versus sort of reward? Although it's, I suppose it can be quite difficult to tell where the middle of the Bollinger Band is going to end up being, right?
Yeah, so we have had this example with this extreme long wick. So
Yeah.
Shadow, you can do any management and any risk management, which is really proper with this. But the moment you see this, I mean, there's no question asked. So of course, this, but
Are
this
you?
this is
So you're showing you're showing the chart because it's just on the front screen at the moment. Oh, yeah, there you go.
let's see.
Yeah, there we go. Yeah.
Where was here? This one. So you
That's right.
see
Yeah.
this. So how can you define any risk management here? But this is so brutal, right? So yeah, it's worth a try, but I wouldn't give too much space. Maybe put the stop loss here. So
Right. Okay. Okay.
so then you have a reasonable risk reward ratio. So if you from here, if you measure the risk reward ratio, which is possible, this would be your target. Yeah, yeah, so, sort of. But of course, this is moving, right? And if you don't have any volatility, then it can also happen that you feel like, wow, there's a lot of profit to get, and then you end up, I don't know, like here, right? Because the bands
Yeah. Exactly.
gotten closer together, and you got out of the trade just because the bands come to your price, and this is what also happens.
Do you, I mean, do you actually factor in? You just mentioned there, like the bandwidth of the Bollinger Bands. Do you factor that in as well? Is part of your strategy? So if it's very tight, would you, perhaps put on? You
Yeah.
expect it to expand out more, so you put on a larger position or something like that, or?
So if I have let's see if I have this one, let's focus on that. So
Yep.
you have a bearish engulfing here. You have outside of the band. So this is good. So I see this is about 700 points at pips. So this is the Aussie dollar to US dollar. So I have at least 700. Let's maybe 1,000 pips as a profit target. So this is a reasonable risk reward ratio. This is why I want to enter the trade. But you see, if you exit here, there's just a small profit. to protect you from a high loss, and just to make sure that you don't move, that you don't have to move your stop loss to the entry point for break even. So this is one, but the major profit is here. So I just want to make sure that from here, from my entry to my exit, the other side of the bondage events is at least as a risk reward ratio with 1.
Yep. Okay.
This works here, but this won't, of course, work here. So maybe also here, but this is high volatility. And if you have just a low volatility like here, this is pretty clear that the price goes sideways, and and you see what happens right here to the bondage events, so they tighten. And then you see this might be your exit, and then you exit at the middle of the bondage events with a loss. Right? This also can happen, not very often, but happens, sure. And it's okay, because you can't expect something what is not happening. If price don't move, what can you do?
Exactly, yeah. Do you, so we've covered the time horizon, so you're quite sort of short term. You mentioned 2 minutes, 5 minutes. Have you sort of looked to kind of program this into a scanner to kind of find opportunities then when?
Yeah, I have a scanner. It's a scanner of the Nano Trader, which is with my broker in Germany or Europe. And well, actually, I'm just looking for. I want to do this with a MetaTrader as well. And it takes time. So I'm not a programmer. I'm doing everything, but not programming. So again, also you feel free, contact me if you want to help me out. I'm more than happy.
Sounds good. Okay, I think no more questions, so I think we'll end things there. So Wieland, thank you very much for a great webinar. It's really good. Thanks everyone for listening in, and everyone stay safe, and see you in the next one. Thanks very much, guys. Thanks.
Thank you. Bye-bye.